So it was in April last year when I presented this video on GARP. In it, I explained what is GARP, growth at reasonable prices, how does it work, the PEG ratio. Watch the video, it's all there and I won't be repeating any of that theory. There was also some practical stuff in that video, 3 distinct GARP-based approaches and also a list of stocks against each of those methods. Let's look at these. Framework 1 was a simple formula from ainvest.com. This yielded 83 stocks, which I think is a bit too much. Now, had I invested in these 83 stocks, then over the past 15 months, it would have given me an absolute return of 12.2%, which I'm sure you'll agree is a big disappointment when one compares it to the 113% this portfolio had delivered in the previous year, that is from April of 2023 until 24. The second framework was something SOIC had proposed in one of their videos. It was almost entirely large caps, and as a strategy, it had delivered an absolute return of 15.8%. I should mention here, rather than it being a GARP strategy, this came out more as a sectoral strategy with over 70% of the portfolio comprising of banks and NBFCs. And the third GARP framework is what I had proposed. This comprised of many small and micro-cap companies, more than 80% of it, and as a portfolio, it delivered returns of 7.6% from April last year until today, that is the 23rd of August 2025. Ab kahan 115%, kahan 7%. When I told my friends about it, look at the kind of reaction I got.
Seriously? We trusted you.
इन्फ्लुएंसर का दिमाग यही होता है.
इन्फ्लुएंसर बन के आया है और कुछ आता ही नहीं.
What the hell, man? यही एडवाइस था तुम्हारा?
ये मैडम बहुत गुस्सा हो गई थी मुझ पे. But ultimately, it's your choice. You can either be like her, write some nasty things in the comment section, go away, or you can learn from what happened here, make adjustments in the strategy, you can improve your expectations. And if you do all of this, I'm very hopeful over the long run, both you and me, we can make a lot of money from it. The choice is entirely yours. And for those who want to go deeper into the details, let's begin. Alright, so as we're doing a review of the GARP strategy, let's start with the performance. And as we all know, there's stock performance and there's also business performance. Now for the 27 companies that had come up on my screener, as far as the stock performance goes, only 11 of them gave positive returns while 16 of those stocks were in the negative. और ऐसा नहीं है कि only this selection was bad. Even amongst companies in the Nifty 500, many of them did not do well in this period, at least from a stock price perspective. With regards to business performance and from a list of 27, things were a lot better with 75% of the companies showing positive growth. The reason I'm explaining all this is so that you can get a lay of the land, you can understand different variables, sales, stock price, EPS, the time duration, etc. Anyways, so 3 out of 4 companies showing positive growth might seem okay, but it's not that okay, right? I mean, if one looks at it from the context of the original query, wherein we were aiming for a consistent sales growth of 15% from every company, that has definitely not happened in this past year. In fact, only 12 out of the 27 companies have a sales growth of 15% plus. So that's a problem, and what is an even bigger anomaly is that the 15% EPS that we were additionally looking for from the query, even that hasn't happened per our satisfaction with only 7 companies meeting that criteria. Now, this might lead us to conclude that the screener hasn't been doing a good job of filtering the companies for us, but I think that would be a bit unfair on the screening platform. Why? 2 reasons. Firstly, I've always said this, never use a screener to pick stocks. A screener has been created purely for screening. It's merely looking at the historical data. It looks at quantitative information. And you and I both know there is a lot more that goes into picking stocks. The second reason, and again this is something we both know, is that every business, or for that matter every economy, goes through a period of ups and downs. Take the last few years, and for each of these 27 companies, notice how tough the previous year, FY25, has been. Most of these companies have failed to reach the 15% mark, both in terms of sales and in terms of EPS. And it's not just these 27. In fact, FY25, financial year 25 was rather harsh across the Nifty 500 companies, with the EPS growing by a mere 7.7%, which is also why the index did not perform well during this period. And it's not just last year, one can see this across years, which confirms and reaffirms my belief that one of the most important factors that determines the price of a stock is its earnings per share. What this data also shows us is volatility, extreme volatility, which one should expect from any equity-oriented growth strategy. And if it's something you can't stomach or if you wish to avoid, then an alternative worth exploring are those high-yielding fixed income bonds on the Wint Wealth platform. So very quickly, Wint Wealth is a SEBI-registered broker that offers something called senior secured bonds. The bonds come with two distinct layers of protection. Firstly, these are backed by collateral, gold, receivables, etc. And these bonds also have a priority in the repayment hierarchy. In terms of returns, they offer fixed returns in the 9 to 12% range. 1,000 rupees, that's all it takes to start investing on Wint Wealth. These bonds are liquid. You can sell them anytime you like. And presently, there are 22 live offerings for you to choose from across companies, tenures, interest payouts, etc. And if you're someone like me who likes more return per rupee invested, in addition to a balanced portfolio, then I think as an instrument, a senior secured bond perfectly fits the bill. To learn more about it, do watch this video of mine and also watch this one for an honest review of the Wint Wealth platform, and you'll understand why it has become my top bond shopping destination. So if you're looking to diversify your fixed income portfolio, get a bit more bang per buck but without the volatility that equity presents, then do check out Wint Wealth. As always, the link to the platform is available in the video's description. So from what we've seen, all the data that I've shared, it basically tells us that the GARP strategy, like any other strategy, it goes through a period of kabhi khushi, kabhi gum. When is khushi, when is gum, we don't know. It's not easy to predict that. As a long-term investor, I also don't force myself into thinking that way, but as a strategy, GARP has worked effectively and efficiently for many decades now, and there is absolutely no indication that it won't work in the future. Actually, let's do this. So remember the query I wrote in my previous video, ye wala? Now let's run a backtest on it. I'm using Trendlyne for this. Please note the query one writes on Screener and what you write on Trendlyne will be a bit different. So this is the same query, but as per Trendlyne, I think I've covered everything here. Cool. Let's quickly preview the results. Sab theek. Save Screener. Okay, naam de dete hain. Let's say GARP _ Shankar. Save and finish. And we have everything we need. Okay, now we want to do a back test. Let's go back to the platform. Okay, you see this watch wala icon. So this is back tests. Let's tap on it. 12-month frequency, bilkul theek. No, I don't want to do 3 or 6 months, too short. Start date is 2015. The end date, let's make it 31st of March 25. So what I want to do here is I want to look at how my GARP strategy would have performed over 10 years. Alright, let's run the backtest.
A few moments later.
Okay, there we go. And shabash, over 10 years, we have a CAGR of 19.7%. And although it doesn't show here, the Nifty 500 during the same period came back with a return of 11.9%. So that's an outperformance of 7.8%, which means while the Nifty 500 turned a rupee into 3 over the past decade, my simple GARP strategy would have doubled it, turning that same rupee into 6. I'm not sure if this 19.7% includes dividends or not. I don't think it does, which means we can add an extra 1.5% to this performance. But abhi ke liye, let's not get too greedy. Okay, let's continue. I'll click on backtest details. Okay, we'll come to these percentages very soon, but notice these two entries at the bottom. The average number of stocks are like 47. I'm sure there's a way of restricting this number to say 20 per year. I'll figure that out some other video perhaps. And secondly, the average holding period is about 1.5 years. I'm not surprised by this. As I said earlier, no business operates in a straight line in a linear fashion. Everyone goes through ups and downs, and corresponding to that, companies will move in and move out of the strategy. Let's do a period analysis now, and here's an important chart. So this gives us the yearly returns of my GARP strategy, and notice how up down this is. 7% in FY16, then 53% in 16-17, FY19 and 20 were pretty rough, a 17% drop followed by negative 34%, which means the portfolio actually went down to half during this period. FY21, 22 and 24 was when my GARP strategy made a lot of money, and as I mentioned earlier, the last 1 year has been just par for the course. So this shows how volatile GARP can be, but that said, it's a system, it's a strategy, and every strategy would have good days and bad days. Let's also look at the stocks, entry and exit, and see this. Some 432 stocks were bought into with not too much of a difference in terms of the number of stocks that made us money and the number of stocks that did not do well. Even Brightcom was a part of this strategy in some year, and so was Apar Industries, which is amongst the biggest multi-baggers of the last decade. So here's the list. It's neatly classified on an year-on-year basis. You can even export it, play around with it. And in terms of sequencing, here's how the stock additions and exits and the active list stacks up. I'm not computing taxes in this video. It is an important consideration, something one should not ignore. So we had 19.7%, right? Okay, so let's knock off 10% in taxes, which essentially means this GARP strategy gives us a net return of around 17.7%. Dividends might be extra, but all said and done, this is a lot better than what the Nifty 500 has delivered in the same period. Now the question is, could we have done this better? Maybe there are a lot of variables at our disposal. Within growth itself, there's sales growth, profit growth, EBITDA growth, EPS growth, margin growth, cash flow from operations, asset growth, and so much more. There's also expected growth, and I have a few videos on my channel on this, especially the Learn on the Go series, which I absolutely love producing. The other part of GARP is of course the valuations. वो reasonable price वाला जो part है, and there's P ratio, the PEG ratio, price to sales, the PB ratio, price to cash flow, the historical P ratio, dividend yield, EV, EBITDA, etc. We can add even more stuff, return ratios like the ROE, return on asset, the return on capital employed, analyst calls like the number of buy-sell recommendations, the projected share price, technical indicators like RSI, moving average, the oscillators, candlestick, and even parameters like momentum, insider buying, shareholding, Piotrowski score, Sharpe ratio, and much more. I should warn you, please don't go crazy on this and stuff your query with too many variables. You'll probably end up doing a lot more harm than good. I even tried to improve my original GARP query. I did like 60-70 backtests, and believe me, not one single query could cross the 504% return, or rather the 19.7% CAGR that I achieved from the first time I tried it. So maybe it's a fluke, maybe I made a mistake somewhere, but the good part is doing all this backtesting does improve my confidence. It did improve my confidence. I'm now able to see patterns, especially which variables are more important and which ones can be ignored. Hopefully, I can convert this into a viable long-term strategy with my own layer of checks and balances. But one thing you and I can't deny is that every strategy, at least the ones I know, does go through hoops and loops, and I feel building patience and persistence is even more important than building a strategy. That said, if you want me to test out your strategy, then do check out the description of this video. I have appended a workbook link there with some 2000 plus parameters from Trendlyne. And then in the accompanying worksheet, I have put in some instructions on how you can send me an email and how I'll respond back with the backtesting results. I think this will be an interesting exercise. The results might surprise you, but do brace yourself for the inevitable volatility in performance. Of course, if you or anyone you know cannot stomach this volatility, then there's always Wint Wealth. And pleasantly, there are a bunch of fixed income senior secured bonds there offering a YTM of up to 11.75%. Wint Wealth does an excellent job of explaining everything: the rating, maturity, repayment schedule, the pros, cons, the taxation, and every little detail you ought to know. So if you don't mind receiving more returns per rupee invested and are keen on diversifying your portfolio but without the volatility that equity presents, then do check out Wint Wealth. In conclusion, the GARP strategy is something I personally utilize. And yeah, I'll surely be doing a lot more backtesting. There will be more follow-ups to this video, and let's hope it leads me to the secret sauce of long-term growth investing. As always, thank you for your time. Hope you liked this video. Subscribe to the newsletter and I'll see you very soon. Until then.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.